What's up, everybody? I'm Leaf with Adaptable Wealth, and today we are doing a viewer request show. These are shows where I review stocks that are requested in the comment section of my videos by those who subscribe to my channel. So, if there are any companies that you're interested in, please first subscribe to my channel and then leave them in the comments. I can't promise that I will get to every single company that you all request, but I will do my best to get to as many as possible. Today, we're going in depth on ASML, the Dutch semiconductor equipment manufacturer. ASML was requested by Anastasio SVRA and Atbial. I hope I'm pronouncing those correctly. Apologies if I'm not. In the name of transparency, I do own this company. I recently took a position after their 38% drop from their peak earlier this year. Now, let's get to ASML. ASML stock has sold off in recent months as investors remembered that the industry is cyclical and that demand isn't going to be a steady climb upwards. Net bookings peaked in 2022 and have trended downwards for the past 2 years as their customers digest the purchases made in 2021 and 2022. Throw in the economic difficulties that China is going through right now, along with the restrictions that the US government is imposing on high-tech and in many cases normal tech chips, and it's no wonder investors are a bit uncertain about ASML and chip stocks in general at the moment. The result of these challenges was slightly lower 2025 and 2026 guidance than previously communicated, which triggered a 38% drop from its peak in July of 2024. But is this a temporary dip that we should be buying? ASML is a fast-growing, wide-moat company that has a stranglehold on the most cutting-edge technology in the semiconductor industry called extreme ultraviolet lithography, or EUV. Getting such a company at a discount or even a fair price can be a great investment that will pay dividends and supercharge your portfolio over the next decade. So let's jump in and determine if we should be buying it or not. ASML literally has no competitors in the industry for the EUV lithography machines that allow chip makers to develop the fastest and most complex semiconductor chips in the world. They are literally a monopoly because they are the only company in the world that sells the machines required to do this. Their value proposition is one of buy our extremely expensive machines and then pay us for servicing and maintenance for 20 to 30 years, and we will continuously increase the amount of nodes that can be fit onto a chip. And the chip companies do this because the total addressable market is in the hundreds of billions and could possibly grow to nearly $1 trillion in the next couple decades. ASML has a wide moat based primarily on intangible assets and switching costs, both of which lock their customers into using their machines and create significant pricing power. Their intangible assets come from their first mover advantage in the EUV technology. They developed this technology over a decade ago, so the patents that they have on this technology, along with the knowledge and know-how and the supplier and customer relationships that they've built, places them at least a decade ahead of any competitor that would wish to enter this market. These intangible assets create switching costs that really solidifies their competitive advantage. These are massive machines that cost 200 to 300 million each and last for 20 to 30 years. They are extremely complex machines that require routine inspection, maintenance, and updates over that 20+ year period. This is where ASML locks the customer into highly profitable and sticky servicing agreements and software and hardware updates over the life of the machines. As a purchaser of such an expensive piece of equipment, you want to make sure your investment is as productive as possible and lasts as long as possible so that you get as high a return on investment as possible. Therefore, it's pretty much a certainty that ASML's customers will also sign on for the service agreements because they are the only company in the world that is capable of manufacturing and servicing these machines. This creates an extreme dependency of their customers on ASML because if they want to offer the most cutting-edge chips, they have no other choice. There is nowhere else they can go, meaning that this service revenue is as sticky as any other revenue generated by any company on the planet. Even if ASML really screwed something up for a customer, they wouldn't be able to move to a competitor because there are no competitors. Growth has been robust with revenue and earnings growing in the 20% range over the past decade. However, this is expected to slow to the low to mid double digits. Morningstar uses a 10% growth rate in their valuation model, which is still good but significantly lower than the past 10 years. Free cash flow has been declining over the past 2 years as they've built up inventory, increased capital expenditures, and given more lenient payable terms to their customers. I definitely don't like this trend and expect it to correct in either 2025 or 2026, but if it stays low, we could have a problem. ASML's return on capital can be volatile. running anywhere from the low double digits all the way up to 35 to 40%. The average over the past decade has been 22%, more than double Morningstar's estimated 9% cost of capital. So ASML is generating strong value for its investors. Additionally, net margins are strong at around 25% and are expected to expand over the next decade as service revenues become a larger and larger percentage of their total sales. They're in a net cash position, and although their debt has been increasing over the past 10 years, it remains manageable with a 34% debt to equity ratio and only 1.5% of their operating income going towards interest payments. One of the things that I don't like about ASML is their floating dividend. They currently offer under a 1% dividend yield, but their dividend is not set in stone like we see with most U.S. companies. Instead, ASML increases and decreases it to better manage their cash flows. As you can see, it has been steady at around $1.60 to $1.70 per share over the past 5 years, but that can be decreased at a moment's notice. They've also been buying back around 1 to 2% of shares outstanding over the past 10 years, giving them a 2 to 3% total shareholder distribution yield, which is standard for chip equipment makers and should continue near these levels given their strong free cash flow generation. We wouldn't be prudent investors if we didn't understand the risks that come with an investment into ASML. Their revenues are highly dependent on only 3 companies, TSMC, Intel, and Samsung. So any changes to either one of their capital expenditure plans will have a significant impact on ASML's revenue. In fact, both Intel and Samsung have already cut their orders, which contributed to ASML lowering their guidance and the ensuing sell-off. Then there's the fact that ASML must continuously make their machines and processes more efficient if they want to keep their monopoly. If innovation and productivity gains drop off, the demand for these machines could plummet as chip makers look for workarounds to reduce their dependency on ASML. Next, we simply don't know how strict the U.S. restrictions on the export of these machine parts will be in the future. They also single source some of their materials to build these machines. Any disruptions to the supply of those materials or the materials that are used to produce the materials will hit ASML's top and bottom line. And finally, the semiconductor industry is cyclical, so if you're investing in these companies, do not expect it to be a nice, smooth ride upwards. There will be years over the next decade where sales drop and the stock price follows. Barring unforeseen events, these pullbacks will most likely be buying opportunities given the technological phase we're entering. But if you can't stand the volatility, then these types of stocks may not be suitable for your portfolio. Valuation is the primary knock on this company. ASML is still quite pricey, even after dropping 38% from its peak in mid-2024. At 28 forward PE, 10 times sales, and a 1% free cash flow yield is cheaper than it was a mere 6 months ago, but is still quite expensive. CFRA rates them as a strong buy with a $902 12-month price target, while Morningstar rates them as 4 stars with a $935 fair value estimate. And I value them at $855, but with a 25% margin of safety, I'd only be willing to pay $641. So what does all this mean? Is ASML a good investment at these prices? If I had to give a one-word answer, it would be a resounding yes. Given the technological backdrop that we're likely to see over the next couple of decades, we'd be fools not to take advantage of dips in the high-quality chip companies, especially one that has a stranglehold on the very technology that is required for future technological advancements, who's going through a sizable dip because of short-term causes. Of course, I'd like to get this company at a cheaper price, and it may drop further from here, but as Warren Buffett repeatedly says, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. ASML is a wonderful company, and I see their current price as fair. Not great, but fair. So taking a position here is likely to end up being a good investment over the long term, in my opinion. Well, that will do it. I'd love to hear your thoughts on ASML or any of the other chip makers in the comments. Do you agree or disagree? Are you buying ASML during this dip? If so, please leave it in the comments. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Lastly, if you're interested in other high quality companies that could be good buys right now, click one of the thumbnails that you see on your screen. Until next time, you all take care. I'll see you in the next one.